I think probably my favorite part about having this YouTube channel is the feedback that I've been receiving from all of you. Whether it be suggestions of stocks for me to take a look at for a Watchlist Wednesday, questions about how ETFs fit in your portfolio, if it's worth having both ETFs in your portfolio, or just an overall thank you for helping explain an ETF to you. That is really what keeps me going and why I continue to make these videos, because it makes me feel better knowing that somebody out there actually learned something from this video and I created some value for them, and hopefully they walked away learning something from this. Now, full disclosure, I do have this channel as a way for me to hopefully one day start making some money from it, but I think it goes without saying that if I was only after the money for this YouTube channel, then I probably would have given up a long time ago, because I've been doing this for close to a year now already and am nowhere near getting monetized. So, the best part about all of this is truly just being able to help all of you out there. Now, the reason why I'm saying this is because one of the questions I received a while back was if it's worth owning VOO and SPY in your portfolio together, which one's better, if you should just have one or the other, and how do you make that decision? So today, what I want to do is compare VOO to SPY. Hey everyone, and thanks for joining me today. My name is Matt, and if you're new to this channel, welcome to the channel. Thank you so much for clicking on this and checking out my page. Basically, what I do here is I talk about my new career in real estate. I left real estate for I left finance for real estate. So I've been talking about my journey a little bit there, but also sharing some of the knowledge that I learned when I was working in finance to all of you, since I now have the ability to share that with you without getting in trouble with my employer. And as I mentioned there in the beginning, today we're going to be comparing VOO and SPY. Also, if you're new here, I don't say this often, but it's something I've been having to pick up on. Since still like 99% of the views I get are not from subscribers, if you find this video helpful, if you enjoy it, or if you just want to help me out, if you wouldn't mind just hitting the like button gently, don't break your computer over it, and considering subscribing, it would go a long way and means a lot to me as well. So with that out of the way, let's go ahead and talk about these two ETFs. VOO and SPY are both very similar investments to each other because they're both passively managed and they both track the S&P 500. If you're new to ETFs, what I mean by tracking the S&P 500 is these portfolios are basically set up to have very similar investments to what the S&P 500 has, and it allows for you to purchase all of those investments at a much cheaper price. So, as I always say, if you were to buy 500 stocks of the companies that is inside the S&P 500, it would cost you a lot of money. But instead, for around $300, you can buy all of those investments in one ETF. And again, they both just have an objective of essentially performing exactly how the S&P 500 does, taking that true Jack Bogle approach of just buying the market. Now, I'm not really one to typically look at charts. The only time I really like to look at charts is when I am comparing an investment to the index, or just seeing how it performs relative to the market during certain time frames, because it gives a very quick and easy visual representation. But I don't use charts for the sake of looking for trends or lines of resistance or anything like that. But to make this or give you a visual representation of how similar VOO and SPY perform, I did find this chart from ETF.com, and as you can see, it looks like there's only one line on there, but there's actually two lines on there. And that's because since these both have the same objective of mirroring the S&P 500, they should perform identically to each other. There shouldn't be that much of a variance between the two. So when you look at this, we can see that we have consistency between the performance. Now, as you start to take a little bit of a step down and look through like year to date, 1 year performance, 3 year performance, that is where they kind of flip-flop between each other, and that's because they have different weights to the investment. So best example, or best way I could put that is, let's say that the VOO has 6% of the money in that ETF in Apple, where SPY might have 5% of that money in Apple. So the way that they're weighted in the investments can be different, but the actual investments they have are what is going to be the same. I hope that makes sense. So it's the same stocks inside of these ETFs, just how many of those stocks is what changes between these two. That's not the only thing, and we'll get more into that, but I just hope that gives a little bit of an understanding as to why there's these little subtle variances between the two over the years when we look at a more long-term approach. Now, I did want to pull some numbers and just put this easily on a chart so we can take a look at this together, and hopefully again this gives you just another visual representation of these companies. And so I just have a few statistics that I like to look out for with ETFs. There's certainly more information than just this that we can look into, but I always feel that this is a really good place to start and just gives a high level overview as to which might be the better investment for you. As we can see, the price per share between VOO and SPY is almost exactly the same. It's $308 for VOO versus $335 for SPY, so difference between less than $30 is not going to make or break a deal for me, especially when it's something like $300. Now, it is worth pointing out here that in true Vanguard fashion, it does have the lower expense ratio. Not all the time does Vanguard have the lowest expense ratio, but in this instance it does. 0.03% is about as good of an expense ratio as you can ever expect to find. Any lower and you'd have to question how they're even keeping their lights on and paying their employees. So 0.03%, perfect. 0.09%, while it is higher, it's still less than 0.1% of an expense ratio. So nothing worth losing sleep over. If you are going to only focus on expense ratios, then obviously you'll choose the Vanguard one here, but these are both very favorable expense ratios. I should also mention, in case you see some differences between the numbers I have here versus what I just displayed on that chart, the chart came from ETF.com. These numbers I got from SeekingAlpha.com. So we can see the 5-year performance for Vanguard is slightly more favorable, but again, not by much. It's 59.69% for Vanguard's fund and 59.32% for SPY's fund, or for State Street's fund. Such a weird name for a company. Anyway, now we might be able to say that that difference in performance could be from the expense ratio. Not something we know for certain, but that's my guess as to why there's that difference there in that performance. And again, that could be because of the slightly higher expense ratio that SPY has. See, the average dividend yield over 4 years is also roughly the same, 1.94% versus 1.9%. So as I was saying, these are very similar investments, and we can see there's not many differences between these two. Now, again, Vanguard has a lower expense ratio, so that could in turn make for the slightly better performance with the slightly higher dividend, but I wouldn't start selling out of positions quite yet as SPY just to go to VOO for those little differences. Now, what we can see is that the VOO has a better dividend growth rate. Doesn't necessarily mean a whole lot for these because, again, the companies they have are the same, and with the expense management, it makes sense to have that little bit better of a dividend growth rate. But I think where we would see a bigger difference might be in a longer time frame than just 5 years. Maybe if we were to compare that over 10 years, when VOO gets to be 10 years old, we can compare that, or even 20 years old. But for right now, that 5-year dividend growth difference could be considered significant, but again, to me, nothing worth losing sleep over. What we can see though is that SPY is a much larger fund, and we can tell that by the assets under management. So it's weird to see ETFs that are bigger than what Vanguard has to offer, but this is definitely an example of that. And we can see that SPY is larger by about $160 billion. Basically what that means is that there's more money invested in this fund, so more people have invested in it, which also makes sense because, little fun fact here, SPY was actually the very first ETF to trade on a US market. So in theory, it makes sense for it to be a larger ETF than VOO, who's much more recent to hit the market. As we can see, number of holdings about the same. Vanguard always just seems to have like a few extra holdings inside of their ETFs than the other companies, but that's not really a huge difference because they're both mirroring the same market. So, I don't know what those extra 16 stocks are. It could be, the exact same, but not a huge difference between the number of holdings inside of that ETF. Now, the one good thing to see here, and this one's a little debatable, but is the turnover ratio. So if this was a mutual fund, the turnover ratio would carry more weight to it than it would for an ETF, but it's worth pointing out that SPY does have a lower turnover ratio, meaning that they make less frequent adjustments to the positions they have in the portfolio. I've already explained in many videos in the past why that would carry more weight to it with mutual funds. Quick reasoning though, in case you haven't seen those videos, definitely go check them out. But it's because the turnover ratio just means it's going to be higher turnover ratio. It means it's less tax efficient. In mutual funds, those tax efficiencies get passed down to the shareholder where they don't with an ETF. So watch my video comparing ETFs to mutual funds if you want to hear more about that. But it is interesting to see that SPY is more efficient than Vanguard. And so now that we've looked at the numbers, I know I haven't made this decision any easier for you for which is going to be better in your portfolio. So let's take a look at the top 10 holdings in here. Again, this is from ETF.com. I just figured it was a lot cleaner and easier to follow along than something I might be able to create, so that's why I'm taking these screenshots. But as we can see, the top 10 holdings are exactly the same. The only difference between them is how they're weighted. So in theory, you could say that this could be where your decision will come from. I don't think it's anything significant to be making a decision from, but the reason why I say that is because we'll take a look at these top two, Apple and Microsoft. If you are somebody that wants heavier exposure in Apple than Microsoft, then SPY might be the better option for you, considering that it does have about half a percent more is invested in Apple with SPY than VOO. And you can take that on the flip side for Microsoft. Again, not a huge difference as I'm taking a look at this, but that could be the place where you make your decision, is how these companies inside of the ETFs are weighted. If it's a company that you really like and one has a significantly higher weight to it than the other one does, that might help you make the decision. But I think the point that's worth driving home here is, with these funds being so similar, with them having the exact same objective and really performing exactly the same compared to each other, it's not worth owning both of these inside of the same portfolio just to add more diversification to your portfolio. If you do own both VOO and SPY, I wouldn't necessarily say go ahead and sell out of one and put it into the other right now, because that could cause capital gains tax for you. But if you're considering purchasing both of these, I would just pick one. And which one you pick is entirely up to you. If the older fund, sometimes better performer is something that you're after, then SPY could be the option for you. But if you just really want the low expense ratio, and a lot of people out there are very familiar with Vanguard and Jack Bogle, then just take a look at VOO. But I think the point that's worth mentioning here is when you start comparing funds that have the same objective and same benchmark that they're following, it's not worth owning both, because what we want to do in these portfolios is minimize the amount of overlap or redundancy that we have. Because as you start to have that overlap between the investments, you just aren't as diversified as you think. Diversification doesn't come from the number of holdings it has in your account. It has to do with what you're actually holding on to. And so I always say ETFs are a great place to start with investing, and they're always something worth having in your portfolio. But the one thing that I don't think as many people pay attention to is the overlap that they might be having between having so many different ETFs. So unfortunately for this one, I really can't tell you which one is better. And I don't ever really tell you which to invest or what kind of investments to pick anyway. I just try to educate them and help make you a smarter investor. And so you can make these decisions on your own without having to watch a video like this first. And so again, just kind of quick synopsis of this is that these are both 500 indexes. They're both an investment that I would say is worth having in your portfolio, but just pick one. You don't need both. Having 500 index is a long-term strategy that you could use as a way to offset risk. If your majority of your portfolio is in a 500 index and then you just have a few other random, maybe individual stocks, maybe some REITs, maybe other ETFs or bonds, then that's totally fine, because this is going to come with the normal inherent risk that the stock market has, but also bearing in mind that these are all large cap companies that are pretty well established and perform well. And so, it's always worth having at least one of these in your portfolio, but again, you don't need both. And I know I just kind of repeated that and said the same thing, just numerous different ways, so sorry about that. But I hope this helps and just gives you some more clarification as to which might be the better investment for you. Or if you're deciding really just pick one, even flip a coin. It doesn't matter too much. So with that said, I'm going to go ahead and cut my ranting off here, and I'll wrap the video up. So thank you so much for taking the time out of your day to watch this video. If you have any questions for me, please leave them in the comment section down below. If you liked it, if you wouldn't mind just casually liking the video, that'd be super nice of you. And I also hope that you consider subscribing. But you could be anywhere in the world and you're right here with me, and I really appreciate that. So again, thank you so much for taking the time out of your day to watch this, but I will let you go ahead, enjoy the rest of your day, and I'll see you tomorrow for a Watchlist Wednesday.